It's great to see you both. Joyce, let me just begin with you. It doesn't sound in general like you believe or your team believes the drawdown in some commodity prices means we're going to see relief from supply or inflation risks.
Well, I think the geopolitical risks are still there, and all eyes are on Thursday. Are we going to see that those gas flows continue, when Nord Stream is set to reopen again? So those risks aren't going away. And when we take a look at the inflation prints, they're still running very high. The Fed needs to move 75 basis points, but even more importantly, they signal that they need to get rates above 3%. We're looking for the terminal rate to go to 3.25%, 3.5% by the end of the year. But those inflation, the debate is inflation now versus recession later. And I think that all eyes are on the Fed and also on what the geopolitical risks are from Russia on gas.
Right. And even today, Manish, I know it's very short term, but we don't have clarity as to how Russia's going to play that and whether or not these letters of force majeure are for real, whether it means that Europe's time is now. I see today already the IEA says Europe has got to start reducing consumption fast.
No, absolutely, you're right. I think the key concern right now is Europe, both in terms of this gas story, but also keep in mind that the other risk right now is the political crisis brewing in Italy and what impact it would have on spreads. Again, the ECB is trying to come up with an anti-fragmentation tool, but that is supposed to go into effect when rates are going up and perhaps monetary policy is being affected differently in different parts of Europe. But if spreads go up because of political risk, then it's kind of hard to see them acting again on that front. So again, Europe is a key concern. Also on the geopolitical front, China is a concern. We have heard stories about sort of a strike from some of the mortgage owners refusing to pay. So far, things are not systemic right now, but that again also bears watching. Now, coming back to the U.S., I think if we have had high inflation, and we do think that the Fed will now go 75, the 100 basis points seems unlikely. But the way I would phrase what's being priced in the U.S. market is really that a recession is priced. So you saw the commodity prices dropping, inflation break-evens are coming down, and so forth. But the risk of a stagflation is not, right? So the assumption is that Fed will hike to 3.5 or so, and then they'll start to cut. That's what the market is pricing. But what's not being priced is the risk of a true 70s, 80s kind of situation where inflation continues to go up even though growth is slow.
Would you agree with that, Joyce, that we've kind of we're warmer to the idea of a brief recession, but we're not prepared for something that combines it with persistent inflation?
I think the market is prepared for, if at least at the very least, a real slowdown to below potential growth, below trend growth. But a technical recession is being priced in. But I think that the problem, our recession models are showing recession risk at around 50-50. So it hasn't come down, that much, even with some of the better prints that we're seeing over the last couple of days. But I think the recession risks don't go away. We go into 2023 and we're seeing the squeeze on consumer purchasing power. Looking at our data, we're seeing that 35% of households are actually now having some trouble paying bills. So I think these questions are going to linger with respect to what it means for margin compression, respect to what it means for the consumer going forward.